are joined on the phone by the Bloomberg Best and RBS's Global Head of Foreign Exchange Strategy, Robert Sinche. Robert, thank you so much for being with us. Is this essentially a preemptive move by the Chinese ahead of inflation data?
Well, certainly there's the risk of that, and I think the markets are certainly focused on that. That's a little Valentine's Day present we'll be getting here that evening in the States. The consensus is that it picks up pretty meaningfully, gets back above 5%. So certainly I think there's reason to believe that this could be a bit of a preemptive move on the part of the Chinese.
How big of a concern, Bob, is that this is going to slow down the Chinese economy?
Well, I think the greater concern would be if it doesn't slow down the Chinese economy. I think that the interesting reaction we're getting in markets today is really the lack of reaction. I mean, we did get some reaction. You look at the Australian dollar as kind of the bellwether on this because it's a commodity currency, and B, it exports a lot to China. Mm-hmm. And there has been a reaction, maybe a loss of about 0.5%. But that's relatively subdued to the kind of adjustments we've seen in the past in the Aussie dollar when China hikes. And I think that's in our view, it's a bit of a signal that while policy is being snugged up, particularly throughout Asia, we saw Bank of Indonesia raise rates last week. This isn't really an aggressive tightening of policy. We haven't really tightened liquidity dramatically that to an extent that it's going to roll over global growth or really impede what's happening in terms of markets.
Then does that mean that the Chinese, the Beijing authorities, have to move faster, bigger?
Well, I think eventually the world will have to move faster and bigger. We're in that transition period from policy having been very accommodative back, obviously, in 2009, 2010, starting to become less accommodative around the world. But in our view, policy is becoming less accommodative, not really tightening. And that suggests to us that a lot of the trends that we've seen over recent months are likely to continue.
Then, Bob, when do we get to that tipping point, when that happens?
I think we need to see more generalized inflation globally. Clearly, with so many currencies still tied to the dollar, or tied to the dollar at least loosely, those countries still have a part of their monetary policy being dictated by what's happening in the States. And I think as long as the Fed continues to follow through on QE2, it's going to be difficult to get a real tightening of global liquidity. So I think, in our view, it's still something closer toward mid-year, the second half of the year, unless we see some bigger adjustments out of the Fed.
Well, in China, though, Bob, just getting back to that, I want to end with it. What comes next? What do the Beijing authorities have to do next if this is just a subdued response we're seeing?
Well, they're using a broad array of policies. Obviously, they've tried some direct policies on property prices. They've tried some direct policies on bank liquidity and bank loans. I think rather than just relying on interest rates, we have a number of countries around the world, Brazil another one, that's trying to rely on a broad array of policies to try to slow down growth and target prices. History suggests that those aren't usually successful, and that there's going to be a lot more adjustment to come on a broad array of policies as we go forward to try to limit these inflation pressures. And, of course, increased supplies of agriculture around the world would help also.
All right. So it sounds like more moves, certainly more moves to come from China. Thank you so much, Bob. Bob Sinche, a Bloomberg Best and also RBS's Global Head of Foreign Exchange Strategy.